Hey, what's going on everyone? This is Nick Saylor with Saylor Tax and Accounting. Today I'm just making a quick video talking about some things you can look for in your books, in your bookkeeping, whether that's on QuickBooks or wherever else, that you can look at to see if your books are good. There's some red flags that stick out whether you're doing your books yourself or maybe you have a bookkeeper that you're not sure of. I'm just gonna go through a few and tell you what to look out for. All right, so number one is opening balance equity. This is a big red flag if you are in QuickBooks. Opening balance equity is something that you'll see when you run your balance sheet report. Now this, just because it's on your balance sheet doesn't mean something's wrong. You could have added a new bank account or a credit card recently, but basically what it is it's a temporary account within QuickBooks for when you add a new bank account or a credit card to your bank feed. And it shows the balance of what that bank account or credit card was when you connect the account, and then it puts it into an equity account. This should always get like journal entered out to another equity account or maybe an expense account. I won't get into it any further than that, but basically if you run your balance sheet and you have opening balance equity on there for a long period of time, something's wrong and you need to fix that. Okay, number two is vendors and payees. So when you categorize transactions in QuickBooks, it's really easy to put them into an expense category, or at least it should be. I've seen people categorize them to all sorts of things, but that's no big deal. But one thing you should be doing is putting a payee or a vendor on each transaction that you categorize. This way we can run some different reports of, how much you have in expense to specific vendors. It just looks clean. QuickBooks is going to give you reports to run for it, and it's also going to give you error messages in your books review section if you have transactions without payees. It's not required, but it's a good way to have good bookkeeping. All right, number three is a little more generic, but it's again back to the balance sheet, and it's looking at your asset and liability accounts. Generally, if you have balance sheet accounts that are negative, not equity, but for assets and liabilities, there may be a problem. For example, if you have a bank account listed and there's a negative balance on the balance sheet, that doesn't make sense to have negative money in the bank. Similarly, if you have a credit card and it's showing as negative on the balance sheet, that doesn't make sense either, because when you spend money on a credit card, it goes up. If it's negative, it means the credit card owes you money, which unless you have some points in there, cash back, it's not usually the case. There's probably a problem. There's all sorts of other things that can sneak onto the balance sheet too, like different correction accounts, fake asset accounts and liability accounts. Oh, another one that's really good is line of credits. So sometimes you'll take a loan from a line of credit, maybe you'll get 50 grand and then you have several payments, but you also have interest payments. So what some bookkeepers will do, or DIY people, is categorize every payment back to the line of credit as a payment to the line of credit, even though some of it needs to get split out for interest. So a negative line of credit account or loan account is a big red flag. Okay, number four is bank accounts with weird names. Now, this sounds weird, but I kind of touched on this before, but basically, sometimes people will add bank accounts or certain types of accounts in QuickBooks or an accounting software that shouldn't actually be that way. So for example, you can add a bank account or an asset in QuickBooks and call it sales income, right? So then when transactions come in where you're making money and you're actually categorizing it, instead of income, you're categorizing it to a bank account called sales income. This will totally screw up your profit and loss report, basically everything in general, including your balance sheet. So make sure the only thing that's listed as an asset of a bank is real bank accounts. Credit cards, all the same. Make sure that you're categorizing income and expenses to things that are on the profit and loss report. All right, number five, this is a simple one. It's just, are your accounts getting reconciled? Now, I have a screenshot of a place where it's easy to see this below. There's a few places in QuickBooks that shows when your accounts were most recently reconciled. Now, accounts don't necessarily need to be reconciled every month, since there's different tests and balances to see if it's reconciled. But when you have a bookkeeper and your accounts haven't been reconciled for months, or they are reconciling accounts with a ton of uncleared transactions, it's a huge red flag, and it's just poor accounting. Some ways to fix this is just tell your bookkeeper, hey, can you reconcile this account? Or you can go in and do it yourself. The longer you go without reconciling, the more errors that rack up, and the trickier it gets to reconcile when it comes. Now, Reconciling, I should have explained this at the beginning, is basically just making sure that what happened in QuickBooks, what you say happened in QuickBooks actually happened at the bank. There's all sorts of things that can cause those two to diverge, and it's good to check in, monthly on that. All right, number 6, this kind of comes along with reconciling, and if you do reconcile often, this might not be an issue, but this is an even easier test for you. Now, in the bank transaction screen, the bank feed screen, you'll see two dollar figures, and you see that on the screen here. It'll show the bank balance and it will show the QuickBook balance. Now these are generally, going to diverge from each other. If you haven't added, a transaction that's still sitting in uncategorized, it's going to show, one's pulling from the bank live and one is pulling, from QuickBooks. So if you don't categorize it right away, these two are going to be different. And there's other reasons that they might vary slightly from time to time. But if you see that they're never close, if it says QuickBooks says I have $3,000 and the bank balance says I have 40, actually it's probably more often the opposite. QuickBooks would say you have 20 and the bank has only 2,000. You have a problem with what exists in QuickBooks because it's different than the bank. So again, get back to reconciling and get those things right. It's a nice, easy, quick test to see how much money you have in the bank, because we don't care what QuickBooks says if QuickBooks is wrong. All right, number 7, this isn't the end of the world. It's just a little bit sloppy accounting. And this is if things are categorized to parent expense accounts or income accounts. QuickBooks lets you have different accounts in the chart of accounts that are parent accounts and sub accounts. For example, you can have a utilities account and only have that, and then you would categorize, your phone, your electric, gas, all that stuff to the utilities account. Or you can have utility sub accounts. So you have the utility account, but then under that you have gas, electric, phone. So you don't need to have sub accounts, but if you do have sub accounts, you should only be categorizing to the sub accounts. You don't want to have, $700 of things categorized to those sub accounts, but then have a random 150 extra like water, you just don't want something in the parent when there's subs under it, because it gets confusing looking at it. All right, and then this isn't one necessarily to look in QuickBooks, but this is just something you'll know each month. If you have a bookkeeper, you should be getting regular financial reports from them. A monthly close is something that bookkeepers and accountants do to kind of keep us in check and keep us in line. We do work throughout the month, but at the end of the month is like the sacred month close to us, or at least I would say it should be. This is when we go through and we reconcile everything, we look at the accounts, we make sure that nothing weird is sticking out, and that's kind of what keeps us honest throughout the year. If we didn't have this month close period, we'd probably just categorize everything and check a lot less often, maybe quarterly or at the end of the year. So as part of this, a good sign of a good bookkeeper and a good accountant is that they're doing this month close, and a sign that they're doing this month close is that you're getting regular financial reports. They at least send you your profit and loss and balance sheet report, and it shows that it's getting reconciled most months, or that it at least looks right. So again, financial reports are important, not just for the data that it's going to show you, but also to show you that your accountant and the person doing the bookkeeping is actually doing the bookkeeping and doing it well by checking in monthly. All right, that's all I have for today. I hope this helped. Maybe you had a few ways that you could go check if you do have good bookkeeping right now. A few of these things you'll see aren't the end of the world. It could just be a conversation to have with your bookkeeper, but if you are DIYing it and a lot of this sounds foreign, and maybe you see several of the issues I just described, might be a good idea to get in touch with someone. Thanks for watching. As always, this is Nick Saylor at Saylor Tax and Accounting. Have a good one.